On the podcast with us today is Jorge Abreu with Elevate Commercial Investment Group. George, looking forward to having you on the podcast today and talking about this large 1,275 unit portfolio, which consists of 5 properties located in Houston, Texas. But before we dive into that property, George, I want to have you introduce yourself to the audience, tell them a little bit about your background and what you're doing right now in the multifamily space.
Sure. So one, thank you for having me, Dan. I've been looking forward to this podcast. And as far as how I got started in multifamily, I actually I'm originally from South Florida. I now live in Dallas, but I have an engineering degree from Florida International University, and I started working out of school, started working for UPS in the engineering department. While I was doing that, I was also doing single family investments. Landed a couple of those, wholesales and some fix and flips. Decided to quit my W-2. So started doing single family investments full time. Was going great till 2008, and South Florida got hit pretty hard. Looked around, found that Dallas was pretty stable compared to some of the other cities. Made that move to Dallas and continued to do single family and also some smaller multifamilies. So I started doing some holds, which led me to about 3 years ago when I started looking more into multifamily. Actually, I'll even go a little further back. So when we moved to Dallas, I decided to open a construction company as well to help scale the fix and flips. So on my construction company, about 4 years ago, we started doing more commercial and multifamily renovations. I started speaking to some of the clients, the multifamily investors, and found out what they were doing, and how they were closing on these 200, 300 unit apartment complexes, which before that I thought was, I didn't think you could do that. It was out of my mind. So I kind of got fixated on that, started looking into it, got the knowledge, and then slowly started transitioning from single family to multifamily to the point where I no longer touch single family. I'm all in on multifamily, super passionate about it, and that's what's led me here.
Well, I know I'm excited. I'm sure our listeners are as well. This has broken a new record here, George, in this large 1,275 unit portfolio. So obviously it's not all in just one property, but it's a
Correct.
large acquisition. And so I'm excited about diving into this. And what I'd like you to do to get us started is talk us through how you found this acquisition and started the process of looking into it.
Yeah, so starting probably middle of last year, started doing a lot of networking, going to a lot of different events. And the way we originally started getting into multifamily was with other co-GPs. We found the strengths that we had, which was that I had a construction company. I knew the CapEx and the due diligence really well. And we were good at finding properties. From the single family, we were used to having to go out there and go straight to the seller. So we leveraged those things as far as finding the properties and the construction, brought that to other groups that had the experience, had the experience raising equity. And that's how we partnered on our deals. So earlier this year, in that networking, I met somebody that was acquisitions for a group out of South Florida that had over 8,500 units, and their specialty was finding portfolios. So as soon as we made that connection, went out and met their team and got their criteria. We pretty much took their criteria and started looking for deals right away. And we landed this one in Houston. We found it through a broker. And they were listing it or putting it out there whether you can have each property or the full portfolio, 5 properties. What attracted them to us was the fact that we were willing to take it all down, and we were able to actually come in lower than some of the other offers. But the fact that we're going to take them all down and the track record we had behind us, they went with our offer.
So when you're going through the different offers on this one, how much competition was there with this type of a portfolio? Was it more competition, kind of piecemeal different properties, or was there actually some more competition from the whole entire portfolio?
Yeah, so there was not a lot of competition on the whole portfolio. On the piecemeal, yes. So that was a struggle in the beginning, and we were able to prove to them that we could close on the full portfolio. And I think once we did that, I think there was only two others that were bidding on the full portfolio.
And how many rounds of offers did you go back and forth on as far as the entire portfolio?
Yeah, it was just one round.
So you made that first offer, and then they basically accepted that first offer?
No, I think there was a counter, but there was no true highest and best, you know, how they do
Okay.
now.
Oh, yeah.
They did counter, and we went back and forth a little bit, but they had already made, at least it felt like they had already made the decision that they were going to go with us.
Yeah. So what did you end up buying the entire portfolio for?
The entire portfolio was around 75 million. That's purchase price.
Mm-hmm.
So about 59,000 a door.
And how much hard money did you have to put up on this particular portfolio?
So day one, we didn't have to put any hard money. We were able to negotiate, which is kind of unheard of in DFW and Houston now as well.
Mm-hmm.
But we had built a really good relationship with the broker, so we were able to get away with not having to put hard day one. I believe we put, if I remember correctly, I think it was 200,000. And then we had another, so after due diligence, we had to put another 200,000, and at that point it was hard.
Okay. So you did $200,000 upon signing of the PSA. That was non-refundable up until due diligence. And once you got to due diligence period completed, you had to put up another 200,000, but the entire 400,000 would be hard or non-refundable at that point.
Correct.
Okay. How long was the due diligence period?
It was 45 days.
Okay. So 30 days would be pretty tight on that many units.
Yes. Yeah, and we walked every single unit. It took a team for 5 full days.
I can imagine that's definitely a lot of units to have to go through.
Yeah.
So as you were going through each one of the units, did you notice anything that was kind of out of the ordinary that maybe made you kind of go back and, retrade or anything like that?
Yeah, no, so we didn't do any retrading. I mean, it was we were really happy after we walked the units after the due diligence. Nothing alarming, there's poor property management, which we knew. There was more upgrades than we thought on some of the units, and really only one of the properties is a heavy lift out of the 5.
So we hear this term of poor property management a lot. I always feel like sometimes it's overutilized. What are some of the things that you noticed on this portfolio that you would say, yeah, that was definitely poor management?
Some of the vacant units kind of just sitting there and not ready to be leased was one. And then we talk a lot with the staff. We're careful with what we say, obviously, and if we have permission from the seller. But just from our conversations with the staff as well, and that was pretty much it. I mean, also some things just walking around, some of the deferred maintenance.
Did you have any interactions with some of the residents?
Absolutely. Yeah. Any chance we get, we definitely talk to the tenants quite a bit. Most of these are workforce housing. A lot of the tenants in this area are mostly Hispanic. Me and my partner both speak Spanish, so a lot of times we'll start talking to them in Spanish as well, and they feel a little more comfortable sometimes, and they'll be honest.
A lot of the times you can also kind of go online, look at some of the Google reviews or Facebook reviews, and you get a lot of that, the reasons why you have poor management. Even though the property manager might tell you to your face that things are going well and they're doing certain things, those reviews sometimes can be telling, even though sometimes they're probably a little bit too much. But I think for the most part, if there's more than one person that's talking about the same thing on those reviews, it's definitely an eye opener for sure.
Yeah, I've seen a lot with bed bugs and pests overall. Yeah.
What was the occupancy of the property when you guys acquired it?
On average, the 5 properties was about 94%.
It's pretty strong.
Mm-hmm.
What's the submarket typically?
The Houston in that submarket, you're around 95, around there.
So you're right in line with the submarket there.
Mm-hmm.
In other words, was there one of the properties in that portfolio of 5 that was kind of underperforming than some of the other ones, and that kind of took down some of the higher performing ones, or was it pretty much all across the board the same?
No. There's 2 out of the 5 underperforming. So I think a couple of them were like at 96% occupied, and then there was nothing under 90. I believe 92 was maybe the lowest.
Mm-hmm. And that's physical occupancy. Was there a big discrepancy between physical and economic?
Not huge, but yes, that is physical that I'm talking about.
Yeah. Now, one of the things that I am curious about is during your due diligence, walks, not just necessarily your walks, but also just the inspections in general. Was there anything else that was kind of found out during that due diligence period, whether it be the financial due diligence or the on-site due diligence, that maybe kind of, brought some additional questions to the table about this particular acquisition?
We did find some plumbing issues during the physical due diligence of the property. Some roofing issues as well on the flat roofs, but nothing too alarming that threw us off and said, we got to walk from this one. Mm-hmm. On the leases and the financial, we did start to see, so this isn't really during the due diligence, this is more as we're getting closer to closing. Mm-hmm. Some of the occupancies started dropping, which we know is pretty common. But we were able to get ahead of it, and it was nothing too dramatic.
So a lot of people, that might be listening right now might be thinking, I've underwritten one deal and kind of, made an offer on it, or maybe even acquired it, but to sit back and actually underwrite a portfolio of 5 properties, what's that process like for you when you're trying to analyze a project like this?
Yeah, so it's it's the same amount of work as doing one property, just multiplied, obviously. We have a good model spreadsheet that feeds, as you work, you knock out one property at a time, obviously, and then that at the same time is feeding into a summary sheet that then shows you how the whole portfolio is performing versus each property. And the way we do it is we have a rough model, very basic, just shows if it's even worth digging deep. And then we have a more sophisticated model where we dig deep into it. Our team, Elevate, will finalize that. If it looks good, then we'll send it over to our co-GP on this deal. They'll do the same. So we got 2 eyes on it.
So obviously I haven't seen any models out there right now that have this portfolio kind of piece where you can underwrite each deal and it's kind of building into a summary. Is that like a spreadsheet that maybe you guys have put together and built out for your team as a proprietary model, or is there something out there on the interweb that you can actually access to be able to put this together?
Yeah, no, I haven't seen anything this sophisticated. This is something that we put together.
Yeah. I was going to say, because obviously when I'm first thinking about a portfolio, which our group doesn't go after portfolios, but when I'm thinking about a portfolio, I'm thinking underwrite one deal, figure out what those numbers are, the second, the third, the fourth, the fifth, average them all out and figure out, is the deal going to work? And I'm sure the model does something similar to that, which
correct.
Have a model to do that, right?
Yes. Yeah. That's exactly what you said, but in the background. Yeah.
Yeah. So you don't have to keep on updating the numbers. As you update one property, it automatically updates that summary.
Yep.
That's great. That's awesome. What did you guys do for financing on this one? Obviously it was a portfolio. It's above 90% occupancy. Did you guys go with bridge with maybe some of the because of some of the CapEx, or did you go straight to agency?
Yeah, so we debated it in the beginning. We were thinking we were going to go agency. And then as we started digging more into the CapEx, like you said, and the interest rates, I mean, the way they were dropping, we decided to end up going bridge and get the higher leverage and also give us that flexibility on with the interest rates, and then within 2 years not having to be stuck with an agency. So we also we have a preferred equity partner on this deal. So this gives us the flexibility of between year 2 and year 3, we can actually take them out of the deal and the returns just kind of skyrocket after that.
So you're using a bridge lender plus a pref equity or mezzanine. Is it mezz equity or more like mezz debt?
It's so no debt. It's
Okay.
It's equity. Yeah.
All equity. Okay.
Mm-hmm.
All right. And with the bridge lender that you used on this one, what kind of loan to value or loan to cost were you at?
I believe it ended up being right around 70. I want to say 72% or so.
Was that loan to
Loan to
or
cost. Yeah,
loan
loan
to
to
cost?
cost,
Okay.
including CapEx,
Okay. All
closing
right.
costs.
And how much was what percentage did the pref equity person bring in?
Percentage of the total capitalization.
No, percentage of the total equity required to close.
Okay, so about 50%.
Okay. And how did you structure that particular pref piece?
So the pref is structured at 8% pref, 70-30 with a hurdle at, I want to say the first hurdle is at 12% IRR. It goes to 40-60, and then I believe it's 16 or 18%. It goes to 50-50.
Okay. So throughout the entire piece, they're going to be participating in some of the upside along the way.
Correct.
Okay. Now on the other side of the 50%, how did you structure that with investors, with your private equity piece?
On the common equity then?
Yeah.
The other equity we raised?
Yeah.
We decided to keep it the same, pref and hurdles. That way all the equity's getting paid the same way.
Okay. So technically it's not a pref equity because everybody's pref equity.
Correct.
Yeah. And for those of you who are listening, what I'm trying to get at is that a lot of times what you'll see is which George has done something smart. He's just basically kept everybody the same to make sure that they're all feeling that they're aligned. But what you'll sometimes see is you'll see a true pref equity piece in the capital stack that gets higher preferential treatment. And then you'll have the other piece, which is the common equity, which will actually get a different split or different piece of the equity. Now, obviously, in the capital stack, I'm assuming that that's one of the reasons why it's pref is because they're going to get paid their piece first before any of the common equity. Is that correct?
That is correct.
Yeah. So that definitely in the capital stack, they have that preferential treatment. But as far as the equity splits and things like that, they do not. Which, again, it's as a pref equity type investor, it is a great position to be in because you're not necessarily guaranteed it, but when you're only doing 50%, you're pretty much guaranteed to get that return that you're looking for on that money. Yep. And a lot of those pref equity groups are only looking for 12, 13, 14% IRR, and they're happy, right? But if you can get even more with that, obviously this allows you to be able to be opened up for even more deals in the future as well.
Correct. Yeah. Yeah. We debated a couple different models, but at the end of the day, we thought this was best.
No, I think that's good. What kind of fee structure did you have set up in this one?
We had a 1% acquisition, 1% disposition, and I believe 1% asset management. Yeah.
Okay. And who is going to be doing the most of the day-to-day asset management on this portfolio?
So our co-GP has in-house property management. So they'll be, or they are the property manager on it. But
Is that the group? Sorry to interrupt. Is that the group that you said earlier on that was based out of South Florida that had the 8,300 units?
correct,
Okay.
correct. Um, so they'll be doing it, but we'll also be getting monthly reports and meeting with them monthly. So kind of doing asset management as well.
Okay. And I'm just curious. The things as questions are coming to my head. The
Mhm.
1% asset management fee. Are they getting paid that asset management fee wholly, like 100%? Or are you getting a piece of that as well from your side of the asset management?
We're getting a piece of that as well.
Okay. All right. So they're doing the property management. So they're going to get the property management fees, whatever those are. And they'll probably, I'm assuming they're going to share in some of the asset management fees.
Correct.
Yeah. Okay. Right. So how did you end up raising the other piece, other common equity, if you will, from investors?
Yeah, so we had the pref equity check was 10 million, so we had a remaining 11 million of equity to raise. We had a couple other big checks come in. We had a couple over 2 million, and then the GPs put in around 2 million as well. And the rest was, raised the way you raise equity from.
And you did this with a 506C, I believe, correct?
This one was a B, actually.
A 506B. Okay.
Yeah.
And how I'm trying to see how to phrase this question. Some of the larger checks that you had coming into this particular deal, were these like other groups that of like chunks of equity that could come in alongside you, or was this actually other investors that you had just kind of built relationships with, or maybe some other co-GPs or co-sponsors that built relationships with to bring some of these larger checks?
They were other co-GPs that we had built relationships with.
Okay.
And I know one of them came from a fund, and actually two of them came from a fund. Yeah.
Okay. So these were people who are raising money for multifamily and had some equity sitting there, needed to place it. So they decided to place that equity in your particular project.
Correct.
Okay.
Correct.
All right. Good. And let's see here. Can you think of any other issues that maybe came up along the process that we have not touched on or haven't talked about yet?
Yes, I know we did have, so it was maybe like 20 days or 30 days before closing. We got some updated financials, and I mean, I kind of touched base on the lower of vacancies or higher vacancies. So then we started digging back in, and we got permission to actually go walk the properties again from the seller. And we found that some of the employees had been moved. So the seller had some other properties in the area. So they had pretty much handpicked their best employees and moved them over to other properties. We had worked it into where we could interview the employees before we closed. So we had already done that process, and we had already started working 2 months before we closed. We had already hired a regional manager, and we had already started finding the staff. So we were able to get ahead of it, but it could have been a problem.
Mm-hmm. Were they self-managing, or did they have a third party working on it as well?
They were self-managing. When they first purchased the portfolio, they were doing third party, and then they decided to start self-managing, which they had never done before. So I think that's where not poor, but where we felt like we could come in and improve the property management.
Mm-hmm. Mm-hmm. And with their self-management, you said they had some other properties in the market. Are they like a large player? What type of group is this that this was bought from?
They're not massive, but I guess we'll go into the reason they were selling is they want to go out of C class or workforce housing and go more into A class properties.
Mm-hmm.
I'm not sure if that was because they were having issues managing them, but that would be my guess. And I mean, I believe they still have maybe, last time I looked at their portfolio, maybe like 10 properties.
Mm-hmm. All in Houston?
No, I think there was a couple other cities.
Okay. Okay. And two last questions that I have for you on this. And normally I like to kind of dive into like the unit mix and the price of the rents and stuff like that. But obviously, when we got 5 properties, we don't have time to dive into each one of these 5 different properties. I think we've dove into a lot of different things here, and I've learned a lot myself. But I want to ask two final questions, and they're kind of contrasting questions. The first
Hmm.
question is what did you find was easiest during this entire process that you thought maybe in the beginning might have been a little bit more challenging?
Okay. Um, yeah, the first thing that struck me when you said that was the actual due diligence. When you think of 1,275 units, doing due diligence on that. Um, Luckily, we have come up with a pretty good system on doing it, and we were able to kind of just scale that up, bring in a bigger team, and it went pretty smooth. I mean, I was really surprised at the end of the day, and now that we're in it doing the capex, I mean, our numbers were pretty dead on most of the stuff.
So let's talk about that a little bit. What do you guys do, and what's your process when you're going in and doing due diligence and doing your walks on this, on not just necessarily this many units? Obviously, this is a large portfolio, but on any type of size property that you're working with.
Yeah, I feel like we may be a little more detailed than some other groups, and that's probably because of my construction background. But we try not to have rough estimates. Like when I'm done with my due diligence, I want to know plus or minus 5% where we're going to be at, and have a very detailed scope of work of what we're actually going to do.
Mm-hmm.
And then come day one, after we close on the property, I'm on site and we're getting it knocked out. So we bring in all the trades. Um, we obviously walk all the units, like I said. We take very detailed notes when we walk the units. We know how many units we're going to upgrade. We know exactly what we're going to need to do that. We get all the major items checked out, and not just checked out, like we get a number of what it's going to take to get it fixed if it needs to be fixed. Or a lot of the times I see when somebody does due diligence, they just worry about the deferred maintenance, which is great. I mean, you need to know that stuff and the structural, but we also look at the cosmetic at the same time, and we come up with that plan and what it's going to cost to do that as well. Um, so yeah, for instance, on this one, I think after our due diligence, we had a estimated about 8.9 million or something like that. Now that we've got everything 100% what we're going to do, it's right around the same number. So we're not surprised.
Yeah. So let's talk about that a little bit too. What's kind of each property might be just a little bit different as far as what the renovations are going to be, interior, exterior. Can you kind of walk us through some of the things you're going to be doing to kind of improve the exterior first, and then kind of go into some of the things you're going to do to the units?
Yeah, on the exterior, we're going to paint all the exteriors. The colors that they have now are pretty bad, to say the least. And then we're going to rebrand all of them as well. So all new signage, all new names. Then we're definitely going to add some cedar accents to all of them on the balconies, um, and then fix up some of the amenities as well, like the pools. And as far as adding, we're going to add some dog parks. So obviously we're talking about 5 properties here, so
Mm-hmm.
I got to kind of think about it. And then on the interiors, it's pretty basic stuff. We're going to update the flooring. The appliances actually weren't too bad. We're just going to update them as needed. Resurface countertops, resurface tubs and tile, new vinyl plank flooring, new color scheme throughout. And that's pretty much it.
Yeah, that's kind of a basic kind of cosmetic turn.
Yeah. Yeah.
Were there any things that you guys saw from a other income or from an other income standpoint that might be able to improve the NOI on these properties?
Yeah, there's a couple things. There's some covered parking that we're going to try out on some of the units. And then I know as far as internet, we may be bringing in a provider that we can make other income by providing internet. I know you and I actually spoke about that last time we saw each other. So we're going to give that a try and see how it goes. None of that was in our projections. So, I mean, that would just be extra.
Yeah. Icing on the cake. I like those.
Yes.
That's nice. So last question I have for you here is kind of the contrast to that first question I had before we got off on a couple of those rabbit trails, if you will. What did you find was harder than expected during the entire process that maybe originally you thought was going to be easier?
Okay. I don't know if I originally thought it was going to be easier, but just the preferred equity partner piece. I probably didn't think it was going to be easier because if you talk to a lot of folks, they'll tell you it's not easy and a lot of things can happen and you're leaving. So essentially you have someone telling you that they're going to bring you a $10 million check at closing, but they have nothing to lose that entire time. They can show up at closing and tell you, you know what, we changed our mind. So that part was a little difficult, and then getting them on the same page with our debt and making sure that the debt felt comfortable with it and that the debt didn't feel like the preferred equity was debt, essentially, that it was equity. So that piece was a little difficult, but we were able to get through it.
Yeah. So let's talk about that scenario there, because that's definitely a whole nother animal that we could definitely dive into, which is one of the reasons why a lot of people steer away from pref equity is day of closing, they got you over a barrel. They can ask for more equity just because they have the largest check to write and they don't have anything to lose, but you do. Were there some things that you maybe did to kind of help them have more skin in the game up front? Or was it really just all the way up until closing, you just didn't really know?
No, I mean, all we did is we definitely made them feel comfortable with the deal. We met them out at the property several times. We kept them in the loop with anything that was happening. And that was it, as far as equity or anything like that, we didn't offer more. We just made sure that if they feel comfortable with it, they're going to move forward with it. So we continually checked in with them and just made sure they weren't throwing any red flags on their end.
One of the things that I've heard that you can do, which we haven't dealt with pref equity in any of our projects yet, we've like looked into it and researched it, but haven't actually dove into it yet, is that you can also have them, once they give their green light that they're going to go ahead and invest 10 million or however much money they're going to invest, that you can have them go ahead and help share in some of the earnest money that's already gone hard, so that they actually have some skin in the game. Obviously, 100,000, 200,000 is probably not much for a group that's bringing 10 million, but it's definitely something. And I've also heard some people having them go ahead and put the money in escrow, or at least a portion of the money in escrow, so it's sitting there. And that way, there's not this like all the way up until closing, waiting until you get to that last minute. And because you're right, they could have at the last minute basically said, nope, we're out. They have nothing to lose except for their time and energy and expense involved in it. But you guys are the ones on the line trying to come up with another 10 million a day before closing. Correct. And you have nowhere to go.
Yeah. I wasn't aware of that they would actually do that. So on the next one, we'll definitely try to get them, because I mean, anything, would be nice.
Yeah. Well, hopefully that helps you on the next one. So the next time you get to one, you can at least have that negotiating tactic with them or conversation. And I think the common thing is probably just to share in the non-refundable earnest money, which is really where most of the risk is. And then also in some of the inspection fees, because I can't imagine that the inspections weren't cheap, No.
At the end of the day, there was, I think, over $1 million hard at the end of the day.
Yeah. Yeah. So definitely a lot of money there. And well, you did it, George. So you got it across the finish line, and obviously had some great partners behind you. So it's great to kind of see you go through with that and get all the way to the closing on it. Looking forward to following you on this one to kind of see how it does over the next several years as you continue to improve that community and be able to make some good returns for your investors. How can the listeners reach out to you if they have further questions for you about this particular acquisition or maybe about future acquisitions as you move forward?
Yeah, they can go to my website, which is Elevate CIG, Commercial Investment Group. So elevatecig.com, or my email, which is Jorge, Jorge, at elevatecig.com.
Great, great. Well, thank you so much for being here and participating in the podcast. Looking forward to having you on in 2020 for another acquisition that you close in 2020, and looking forward to continuing to follow you.
Absolutely.
I
Thank you,
appreciate
Dan.
it. Thank you.
Bye.